Greetings, everyone. Happy New Year. Well, last year certainly was eventful, and especially toward the end of the year with the election and all. And so we'd like to, for this In the Know, spend our time primarily on the backdrop, the macro backdrop, including the policy backdrop. And if you'd like more about innovation, just send that in as some feedback, and we'll revert back to both innovation and macros. So here we are, macroeconomics. Well, we got the employment report today, Employment Friday, and something for everyone, but by and large, a strong report. I mean, manufacturing jobs were down, but the headline number was much stronger than expected at around 256,000, with just small downward revisions. Average hourly earnings looked fine. In fact, there was a little bit of a milestone there, 0.3% month to month, but on a year-over-year basis, we finally broke below 4%. Now, we'll get to this in the charts in a minute. If productivity is actually 2% or more, that lower than 4% on the average hourly earnings would suggest that underlying inflation or unit labor costs are below 2%. So the Fed's very focused on labor costs. Productivity is a big part of that. Hours worked pretty flat, but by and large, a strong report suggesting that income growth will continue. Now, throughout the month, there were puts and takes. For example, the claims and the employment report I just mentioned and job openings, those all have been better than expected. But the quit rate has come down. The quit rate is really as low as it usually gets as we're entering a recession. People do not quit if they do not believe they can find a better paying job elsewhere. So that's an interesting juxtaposition, as is retail, or as are retail sales and consumption broadly, better than expected, but we have production weaker than expected. And probably one of the most surprising numbers I've seen recently is an outright contraction in credit card debt for the month. That's unusual as well. There may be some kind of anomaly, but thought that was interesting. The other thing is employment being strong as it is, and yet productivity also being strong. So that's interesting. If you think about economic growth, what is it? It's usually, if you think about GDP, it's growth of employment plus productivity is basically how you can sum it up from a high level. And both seem to be pretty strong. So why has there been such consternation? If you look at the sentiment indices, certainly last year they were terrible for most of the year for small business, for lower and middle income earners. That sentiment did start to pick up after the election, but in recent days, we just on Employment Friday got the consumer sentiment measures, and they've slipped a bit here. And I think what is happening is the euphoria after the election has drifted into uncertainty about what's ahead now that the transition is in place, and we're hearing a lot of talk about cutbacks in government spending. Those are jobs for some people, at least, and tariffs. That's an inflation fear, and that came through loud and clear, as I'll show you in the charts in a minute. There's a great fear that inflation is going to go through a resurgence here, and certainly that's what the headlines are blaring as commentators talk about tariffs. and the saber rattling around them. So what I'd like to do now is go into the charts. As I mentioned, we're seeing mixed and some conflicting evidence. By and large, headline numbers will continue to move forward, but when you look underneath the headline numbers, there are some contradictions, and I think the uncertainty is picking up here. Just to give you a sense of that, as we've listened to various forecasters at the start of the year, you've got some saying that we are entering into a very strong recovery where inflation and interest rates will pick up significantly. So that's one point of view. We have another point of view, which is that deregulation and tax cuts will be a high priority and will dominate tariffs and immigration reform, which will be very good for the markets. But even there's a little uncertainty. And then we have another forecast group, and we respect all of these, by the way, coming out and saying, okay, we're going into a recession. In fact, we may already be in one because permanent job losses have been picking up really for almost 2 years now. And that particular team thinks inflation and interest rates will surprise on the low side of expectations. So the bottom line here is lots of uncertainty. And so I think the markets, both the fixed income and the equity markets, are grappling with this uncertainty. The fixed income markets have backed up. Interest rates have backed up with the talk of tariffs and inflation. And perhaps out of fear that what we saw in the first Trump administration, which was spending, will recur despite DOGE, the Department of Government Efficiency. Now, we don't believe that, but interest rates are up nonetheless. And then equities are equivocating, I would say here, just waiting to learn more, especially as we get to January 20th. And I would say from our point of view, the most important thing that this next administration needs to do is bring clarity to the conversation. If tax cuts are going to be enacted, will they be retroactive to January of 25? And I know Scott Bessent has been talking about that, so that's good. Half of the solution is understanding the problem. But if tax cuts, if there is not that clarity, we can see a lot of deferral of activity, both from businesses and consumers, until there is clarity. So with that, I'll start on the charts for this month. Here you see, again, we're featuring this regularly since the bond market is so worried about it. The deficit as a percent of GDP is still in that 6 to 7% range, in the middle of what's supposed to be a decent recovery. I believe that if President-elect Trump and Elon Musk and Vivek Ramaswamy are successful, that this is going to reverse. And that will be a very good thing. Why? Government spending, as I've mentioned here before, is taxation. If not now, then in the future, or in the form of inflation, which eats away at debt. And that's just bad news for the markets. We believe that there will be more efficiencies introduced to the government sector, and we'll be very interested to see how many people in the government sector accept whatever terms that this administration offers. I don't know if still being planned is, are two things. One, 2 years of income and training to move into the private sector. We'll see if that happens, but if it does, I do believe that productivity will continue to go up quite significantly and maybe surprise significantly on the high side of expectations as technology becomes more and more, technology improvements become more and more a part of what defines this administration, certainly when it comes to the government sector. I wanted to show on this next page Nancy Lazar at Piper Sandler's actually plucked this chart from the source you see below. And the point it's making is GDP can respond to austerity in different ways, depending on what the austerity is. If the austerity is tax increases, you can see how much more severe the response is than if the austerity is in terms of spending cuts and increased productivity. There's hardly any change in GDP with the latter, whereas the former, tax austerity, typically hits the economy pretty hard. We do believe that this administration understands that, and we do believe that that we'll probably see tax cuts and deregulation as the efficiency moves are announced. So one will be countering the other. Here's a chart of productivity. We take it back to 1990 to show you that productivity gains are, if you look in the context of history, in the middle to the higher end of this range. So that's the green. The green is labor productivity. The purple is GDP growth. If we are right, and technology, especially AI, is a huge catalyst for change and productivity in all sectors, not just the government sector, we believe productivity will move up to the very high end of this range, 5% or higher, which is very unusual. It usually happens sporadically coming out of or entering a recession or coming out of a recession. But the surprise this time is that it could be sustained, and that is a very, very healthy way to get economic growth. Productivity, corporations can turn productivity around in any of a number of ways. One is to pay labor more. So if you're not hiring as many people, but your existing employees are taking on more responsibility, wages can go up. Another impact can be higher margins. Another is more spending on R&D and capital spending generally. And then the fourth is lower prices. So we do believe that competition will heat up as deregulation evolves. A lot of regulations today protect entrenched industries, and we think that's going to change. So the combination of that, deregulation, and technology gains that drive productivity, we think are going to become quite significant. You can see in the late 90s how productivity moved from very low levels. It had been stuck in the 1% to 2% range on average for a very long time, and it moved up during that tech and telecom period, tech and telecom bubble. It ended in the bubble. It went into overdrive and too much investment too soon when the costs and the technologies weren't ready. Well, we're ready now. We're ready now. And we're almost at the productivity levels that were in place back then. And we're at just the beginning of the AI revolution that is catalyzing changes in all sectors and is working to accelerate other technologies as well, especially robotics. Here is another anti-inflationary force. I mentioned one of the uses of productivity. A company can turn around and cut prices. One of the other anti-inflationary forces out there is the dollar. Now, if you take out what happened in the early 80s, which was actually a very deflationary period, especially for emerging markets, you can see that we're heading up towards the high end of where the dollar has been over the last 40 to 50 years. So this is a powerful anti-inflationary force, and it is another reason that we expect inflation to continue to unwind during the next year to 2 years. Now, on this next chart, you can see money growth in the purple was negative for quite a long period of time. It moved into positive territory last year. We're still at a very low level by historical standards, roughly 3.5%. You can see inflation in the green line. It broadly, there is a correlation with money growth. Now, the big controversy right now is, are we stuck at this 2.5–3% range? We do not believe that we are stuck there, and that the big surprise will be much lower than expected inflation, thanks to productivity gains, thanks to the dollar going up, and thanks to monetary policy that has been quite restrictive. And I think Chairman Powell still describes monetary policy as restrictive. So inflation typically follows money with a lag. And we do think that we will see more gains against inflation. And we're still saying we would not be surprised to see some negative numbers out there. How could we get those if money growth is turning around like this? Well, we would get that if the velocity of money slows down. And it has been slowing down. And I think the uncertainty associated with the transition to a new administration could be one reason for velocity to slow down, taking any expansionary power away from this money supply growth. So stay tuned on that one. The yield curve has been very interesting. We've featured it ever since we started these In the Know videos, because it went negative and stayed negative for a very long time. You can see here in this chart well, first let me explain what the yield curve is for those who don't know, who haven't been tuning in. It's the difference between the 10-year Treasury yield and the 2-year Treasury yield. And typically, longer-term interest rates are higher than short-term interest rates. And when they are not, when the yield curve inverts, it's usually a period of very tight monetary policy that leads to a recession. So if you look at the shaded areas on this chart, these are the recessions, and you can see that they are associated with inverted yield curves. The yield curve inverts, and then we go into a recession. And it's happened pretty much every time, even pre-2020. I remember in 2019, it's hard to see here, but it did invert for a time. And we thought it was inverting because inflation was so low, and long rates were more focused on inflation and responding to that, whereas short rates were responding to economic activity. Well, we had COVID, and so we'll never know the answer to that if we would have avoided that recession. It looks like technically we have avoided a recession. Now, the closest we've come to this is in 1989. Now, we did end up in a recession then, but the yield curve, and I'll go into, yes, if you look at, again, this is the yield curve in black on the bottom there, and then we've broken the yield curve into long-term rates, which are in purple, and short-term rates, which are in green, on the top. And you can see, if you look carefully at each of these recession periods, the yield curve moved from inverted into positively sloped, primarily because both rates were falling, both the long-term and the short-term were falling, but the short rates were falling faster than the long rates. Now, the exception is in this 1990 time frame. So we'll zoom into that a little bit here. And you can see that rates were actually moving up on the top part of that chart when we moved into inverted territory, or when we were in inverted territory. So rates were moving up. And it wasn't until we were well through the recession in the long shaded area there that interest rates came down convincingly. That was the S&L crisis, and I don't think we have a housing crisis on our hands. We do, in that we are at rock bottom, but the S&L crisis was a function of too much speculation in the real estate market. And we know we're not there now. So it is interesting that this period is like that one, and time will tell. We'll see what happens and what explains all of this. Today we got consumer sentiment as measured by the University of Michigan. And you can see the latest reading in the purple line there. That is current economic conditions. You've got sentiment bouncing a bit. What you can't see as clearly here is the green line, which is expectations, which saw a setback. And the primary reason for that is here, expected inflation rates. And this is what I mean by a transition period, headlines blaring, tariffs, and inflation risks, and inflation is stuck. And so we've got the consumer worried. And on both short-term, which is in the purple, short-term inflation expectations, so over the next year, and long-term inflation expectations over the next 3 to 5 years, both of them popped to 3.3%. Now, you can see for short-term in the purple there, the downtrend has not been broken. What you can't see as clearly is that 3 to 5 year inflation expectation rate. We have not seen 3.3% on that since 2008. So a very long time. The consumer is a little bit unnerved here. And I think one of the other reasons for it is many prices are still very high. Inflation rate coming down does not mean prices are coming down. And the consumer, in some categories, is on a buying strike. Certainly, as measured by goods, a lot of categories are down and out because consumers are just not going to pay up. They'll wait for sales. So I think this is a very important call, the inflation call. It always is, but especially now. And I do think that this administration is very focused on its report card. A lot of that is in the stock market, so it is paying attention to these inflation fears, I am sure, and will probably lean more towards tax cutting and using tariffs judiciously as a negotiating tool. We know from what happened in 2018, those tariffs, that China simply devalued its currency so that we would not see price increases. And it has the opportunity to do that again because it is in a bit of a deflationary period. And I will show you a little later on a chart which would suggest that conditions are getting somewhat alarming in China. Here is another reason that the consumer might be a little less confident. These are permanent job losers. In other words, they're not on furlough, they have been let go, and they're out there looking for a job. Again, I think this factored into the election. It wasn't improving. It actually was deteriorating and has been deteriorating since the Fed started raising rates. That was a very quick response in terms of permanent job losses. And so we'll see what happens in the next few months. But this would suggest that not all is well out there, unless these job losers find more work, and their existing employers are not laying people off because of weakness in their own economic activity, but because they're starting to harness AI and other productivity tools, which is one reason we have seen productivity move up. Here, I'm going to switch from the consumer to businesses now, and I showed you this chart last time around. It is shocking to see how badly smaller businesses are doing relative to larger businesses. This is net income of non-corporate, so smaller companies, divided by corporate. And you'll see we're at record lows. And it gives you, it helps, another thing that helps us understand this is what has happened to interest expense for big companies versus the SMID, or small and mid-sized companies. Net interest expense, because corporations tend to be cash rich, so net interest expense has actually come down and really hasn't been this low for almost 20 years. But look at what has happened to small and medium-sized businesses. They are not cash rich. Many are hand to mouth, and their interest expense has more than doubled. Actually, you could say it's definitely more than doubled in the last 20 years. So huge difference, and you can see this also in the operating earnings per share of the S&P 500 versus the S&P 600. 600 is, or that group is the small and mid-cap group. And you can see since really the peak in 21, the S&P 500's EPS are up 10%, but versus the peak for the S&P 600, earnings are down 50%. And of course, this is the reason that the market has concentrated so incredibly towards just a few, a group of stocks, the Mag 6, the Mag 7, whatever you want to call them. And we do know that the rubber band is stretching for these smaller companies if they get any relief from whatever measure. And I think deregulation could be the surprise here. Regulation tends to protect larger companies. They're pretty entrenched and they have great lobbying groups. Smaller companies don't. So I think that deregulation is going to unleash more animal spirits, and we'll probably see the earnings of smaller companies start rising relative to larger companies in the years ahead, especially if, again, this administration does help engineer lower inflation and interest rates. I'd like to go through a few charts now on inflation, since it is such an important call. And once again, featuring Bloomberg, the Bloomberg Commodity Price Index. We are today where we were in the early 80s, in the early 90s, in the early 2000s. So by this measure, inflation has gone nowhere. And very recently, of course, the strong dollar, commodities are priced in dollars, has pushed pricing down. So again, the dollar is an anti-inflationary force. This chart, usually I show you really from 2008 forward, where the correlation between this metals to gold ratio, which is in the purple, has been very high when you map one against the other on that scale. That correlation has been very high until recently. We're taking this back to give you more perspective and to show you rarely has the metals price relative to the gold price been lower than it is now. This goes back into the 80s. And this is the period of disinflation. And typically, you see that when that line is coming down, interest rates are coming down as well. If you follow this carefully, the correlation is pretty good, and that has not happened this time. In fact, interest rates have moved in the other direction. And I think there is a lot of fear about inflation, although if you look at the breakdown of long-term interest rates and you look at the explanation of, is it real growth, is it inflation, is it just the term structure, the longer duration, it's explained mostly by longer duration recently. But if this gauge of economic health, metals to gold, does not improve, then interest rates, we believe, will come down. Now, this brings us to the shocking chart from China. This chart really started in the early days when it first entered the World Trade Organization. So it is the relevant period of time. And look at what is happening to the 10-year government bond yield. It is collapsing. And we know that PPI inflation, well, is negative. So there's deflation from the PPI point of view. Consumer price inflation is pretty non-existent. What this tells us is that the government probably doesn't mind that its currency is depreciating. It's depreciating right now, and it's hitting the lows in terms of depreciation that we've seen, the lowest points relative to the dollar. So this suggests to us that they're trying to reflate their economy, but they can't do it if they can't get property going. That is such a big part of the economy, and it's 75% of consumer savings. So they are speaking a little more vociferously now about fiscal stimulus and modest monetary easing. But I think they're probably pretty shocked by what's going on here. This is the lowest in the government bond yield since China entered the World Trade Organization. And it basically says not all is well there. Now, what are they doing in response? besides some of these easing measures from a policy point of view. They're really pivoting to innovation. And as we've mentioned many, many times, innovation is inherently deflationary if it's technologically enabled. And there are some surprises coming out of China. DeepSeek, their large language model, is surprisingly performant on chips that are not the most advanced out there. So China is innovating around some of the restrictions that have been imposed on it by the U.S. government's national security concerns. So partly that could be a reason this is going down, but I do think that there is much more of a true deflationary bust caused by overwhelming debt caused in turn by the property sector in China, which will take years to work out of. So it is pretty shocking to see the swift decline in recent months. Something there has changed. So here we'll go back to the controversies out there. Those who believe that we are going to have, a problem with inflation and interest rates believe that this metric, the S&P 500 divided by gold, is peaking out now and is going to roll over much like it did during the 70s. We disagree with that, as I think I've made clear. And you can see the market is trying to figure this out. It's in a holding pattern here. So we're watching this very carefully. And here is the S&P relative to oil prices. You can see on this score, the S&P is winning. Historically, boosts and soaring crude oil prices have led to recessions. They are not soaring now. And in fact, with what's going on in the Middle East, it could be with Iran not sounding as inflammatory, perhaps, that there will be a different attitude as this administration takes office once again. And we would submit that oil production in the U.S., if we do get that extra 3 million barrels, is going to weigh on the oil price going forward and be good for the S&P 500. And then finally, we'll land on this very important metric, Bitcoin, the Bitcoin price relative to gold, the gold price. You can see it broke out at the end of last year. It's testing now. We have seen the gold price go up recently, and the Bitcoin price, while it broke through 100 to, I think we got to 108,000, it's come in a bit, and makes sense that it'll be testing a breakout. As you know, we believe that the Bitcoin price has miles to go for all kinds of reasons that we will delineate in our Big Ideas report. Our Big Ideas report will be out in a few weeks, and in that report you'll see how we get to our Bitcoin price forecast. We are in print, the bold case being 1.5 million. And while we have changed the way in which we get there, we do believe we're going to get there, especially given this administration's sponsorship of Bitcoin. It may even end up as part of Treasury's reserves. So if we're right also that the gold price is unlikely to move out of control in the inflationary environment, meaning disinflationary environment that we see, then Bitcoin will be responding more to its role as a technology and a new asset class than to its role, like gold, as a store of value. And it should continue to pull away from gold in the years ahead. So stay tuned for our big ideas report in the next few weeks. Before that, I think next Thursday we will be putting out our market update, where we focus much more on the questions you have about our portfolios. And so we're trying to tighten up this webinar and that one, and be a little more pure in terms of macro for this one, and more stock focused and innovation focused for that one. So with that, Happy New Year once again, and we're looking forward to a really good year for innovation as this administration comes in, deregulates, cuts taxes, and really gets animal spirits going again.